Hello, Jason Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. At this point, high mortgage rates are becoming familiar news. Last week, we were already nearing the highest levels seen in over 2 decades. So it wasn't a major shock to reach this unsettling milestone on Thursday. Some sources report the record-breaking rate at 7.09% for a 30-year fixed mortgage, while others exceed 7.5%. Both figures are accurate, and I'll explain why. To grasp this, you must recognize a mortgage rate quote is more than just the rate itself. While the rate everyone talks about, officially called the note rate, determines the interest portion of each mortgage payment, it doesn't encompass all interest the average borrower pays. Consider this. Many standard closing costs on mortgages are categorized as prepaid finance charges, essentially meaning it's interest paid upfront. However, what happens when a mortgage has lender-paid closing costs or a builder offers closing cost credit? There's no such thing as a free lunch even here. Whether it comes from your pocket or the lender's, the same sum goes to the same parties. You may ask yourself, what's the difference, and would it be better to have someone else pay those upfront costs? Here's the catch. The lender's capacity to cover your closing costs depends on your interest rate. The higher your rate, the more upfront costs the lender can handle. This is the primary reason why a rate of 7.09% might be equivalent to the rate of 7.5% if one includes upfront closing costs and the other doesn't. The following chart displays 30-year fixed rate indices from various sources. While the figures slightly differ, all three confirm that this week's rates have shattered the long-term ceiling. Now, let's delve into how higher mortgage rates are influencing mortgage quotes. In a stable rate environment, there's usually a straightforward trade-off between higher rates and a lender's ability to cover more of your upfront costs. However, our current environment isn't exactly stable. Over the past few years, there have been moments when a higher note rate could actually reduce the amount of upfront costs a lender could cover. Now, bear with me, this gets a bit technical, but it explains why a higher mortgage rate might mean less to a lender. Whether a mortgage lender decides to sell your loan or not, the loan still has a market value it could be sold for. Generally, a higher interest rate makes a loan more valuable because it accumulates more interest over time. For instance, a hypothetical $400,000 loan at 7.5% could be worth roughly $5,000 more than the same loan at 7%. In practice, this means a lender could either pay $5,000 of your upfront costs at 7.5% or offer you a rate of 7% if you cover your own $5,000 in upfront costs. While some individual lenders might have restrictions on these options, this is the general concept in the secondary mortgage market where mortgage rates are determined. There's one key assumption here. The mortgage must last long enough for the extra interest to be collected. Otherwise, the lender loses money they can't recover. Now, for example, consider a lender paying $5,000 for a 7.5% mortgage, but then rates magically drop to 6.5% 2 weeks later, and you refinance. The lender no longer collects the extra interest, and they're out the $5,000. Though it was a more significant concern when rates were initially surging toward long-term highs, it still holds true that lenders are cautious about paying a premium for higher mortgage rates because they fear early refinancing in a recovering market. Now, moreover, there are already more upfront costs on the average mortgage than we've seen in the past years. Many of these costs are unavoidable as Fannie Mae and Freddie Mac impose them from specific loan characteristics like credit score, equity, and occupancy. Consequently, certain loans with a set amount of upfront costs may leave your lender with no option but to offer you a higher rate with lower closing costs. The bottom line is that while lenders have typically been able to quote a higher rate to keep your closing costs lower, there are scenarios where there's no market for rates that high. In such cases, your only choice is to pay significantly higher closing costs than expected. In some purchase scenarios, realtors and builders may help defray these upfront costs, but it won't be solely the mortgage lender until the secondary market stabilizes. As for a return to normalcy, it's an ongoing conversation. In my next update next week, I'll discuss the outlook for the rest of the year and beyond. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you. Thanks for watching. And if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.